Thomas Cook, a 178-year-old travel operator in the UK with over 22,000 employees, collapsed spectacularly in September 2019, leaving 600,000 holidaymakers stranded overseas. Following the collapse, the UK accountancy watchdog, the Financial Reporting Council, launched an investigation against the auditors EY. It was perceived that EY did not do enough to assess the magnitude of the risks threatening the going concern of the business and other material misstatements. The above case is a key reminder that the audit report should correctly highlight the magnitude of material misstatements and that the appropriate audit opinion should be issued. ISA 570 requires the auditor to obtain sufficient appropriate audit evidence regarding the going concern assumption. In other words, the auditor must have evidence that leads him or her to believe that the company will continue operating in the foreseeable future. In addition to assessing the formal assessment made by management, the auditor also assesses whether there are events or conditions that could threaten the going concern of the business. Examples of events and conditions that could raise red flags include negative operating cash flows, adverse financial ratios, inability to pay creditors on time, inability to comply with debt covenants, breach of legal and regulatory requirements which could result in the company being forced to cease trading, and possible change in laws that could render the company's operations illegal. If events and conditions are discovered that could cast significant doubt on the going concern of the entity, the auditor should obtain audit evidence to determine whether these events or conditions cast a material uncertainty on the entity's ability to continue as a going concern. Remember, the auditor is normally concerned about material issues or misstatements. The auditor will then assess management's plans to deal with these events or conditions. The implication to the auditor's opinion and report is as follows. If the going concern assumption is appropriate and there are no material uncertainties, the auditor will issue an unmodified audit opinion. If the going concern assumption is appropriate but there are material uncertainties, the question will be whether proper disclosures have been made in the financial statements. If required disclosures have been made, the auditor will issue an unmodified audit opinion, but will also include a paragraph with the heading Material Uncertainty related to going concern. The auditor will then discuss the material uncertainty under this heading and will also point to the disclosures made by management. If a material uncertainty exists, but management have not made proper disclosures, the auditor will issue a modified audit opinion. This could either be a qualified opinion if the issue is material but not pervasive, or an adverse opinion if the issue is both material and pervasive. Material means it only affects one or a few significant elements of the financial statements, while pervasive means it distorts most of the elements or the financial statements as a whole. If the going concern assumption is inappropriate but management have used it, the auditor will issue an adverse opinion. To recap, the auditor is required to gather appropriate audit evidence to support the going concern assumption. The auditor does this by reviewing the assessment made by management and assessing whether material uncertainties exist. The type of audit report and opinion issued will depend upon whether material uncertainties exist, and if so, whether they have been appropriately disclosed.